evening. It's Quant Trade Edge, and today I wanted to look at JP Morgan. Yesterday, Friday, JP Morgan announced earnings before the bell, and it gapped down and went straight down. How could we have known when it opened that it was going to go straight down? Well, if you've seen some of my previous videos, you'll know how we do this. We do it by calculating the at-the-money straddle from the day before earnings. So conceptually, think of it this way. At this moment in time, on Thursday, when the market closed, nobody knew what the earnings were going to be. The market didn't know what the earnings are going to be on Friday morning, but it closed at 195.43, and the options market had certain expectations for how far it would move. Those expectations are in the at-the-money straddle. So in this case, the 195 straddle, which happened to be, a straddle is the 195 call plus the 195 put. That is the 195 straddle. And it's called at the money because the 195 strike is closest to where it closed, 195.43. So that straddle was $6.68. And that means the options market expected that there could be a jump to 202.11, which is roughly here. 202.17, close enough. Or there could be a drop to 188.75. So when JP Morgan announced their earnings and it started trading down in pre-market, and then when the pit opened, it opened at 188.32, which is below this line. So just from a nomenclature standpoint, I call this line upper boundary, and I call this line lower boundary. That's just names I made up because I don't know anyone else that's ever thought of this strategy, at least that's talked about it. So this was something that I discovered myself over years of observation. And so this lower boundary, when you gap below lower boundary, anybody who was short a straddle, their calls became worthless, and have no risk. The puts became, if they had sold puts, they are essentially very long stock, and they have to short the stock to neutralize the delta from that short straddle. So that's what causes the positive feedback loop. Positive feedback loop just means a trend. It means that the selling begets more selling, and you trend down. So gapping below lower boundary is what made us know that this was headed lower. And 1, 2, 3, 4, 5, 6, 7, 8, 9. On the 10th minute, it gave a little pop there and then failed immediately on the 11th minute, and that was it. Started heading down. And we can change it to a 5-minute chart so we can see the whole day better. And there was virtually no heat, from here. This little consolidation, which was all just a hoagie inside of here, broke lower. We got a little bit of bounce, lower, a little bit of bounce, lower, and we pretty much closed on the lows. And the lows are very close to one more straddle down. 668 down from here would be about 182.06. And basically when it opened here at 188.32, in this range, you could have got into the 187.5 puts, or the 185 puts, but I typically try to go for the next strike, and those went up 4x during the day, meaning their price went up to 4 times the entry price. So this is a strategy that becomes particularly useful during earnings season, because earnings season will give you some very large gaps. So the key is to be prepared and be ready to take advantage of those. So for example, Goldman Sachs is going to have earnings tomorrow, on Monday, and here it closed at 389.49. We can try to find the at the money straddle and be prepared for Monday's action. And there's one thing of note here on Goldman Sachs that wasn't the case on JP Morgan, and that is that we're already pretty oversold. And I measure that by looking at the 2-period RSI. And that 2-period RSI, if it's below 5, and here it's 2.2, that could mean that a gap down won't be sustained. It would reach a climax of sorts. But let's go ahead and calculate the straddle, and I'll pull up my actual account to show you how that's done. To put in the little code here. So 389.49, 390 is likely the closest strike. So here is the Interactive Broker screen, and you can see that's Goldman stock. And that 385 is some sort of after hours print, and we're not interested in that. We're interested in the 390 level because the last options traded at 3 p.m. and the close at 3 p.m. was that 389.49. So the at the money straddle, and then don't get fooled by these settlement prices because it may or may not have traded that close to 3 p.m. Look at kind of mid-market of the bid and the ask. So going mid-market here, we're talking about 755 plus 8 divided by 2, 777.5. Let's just call that 778. So that's how you calculate the at the money straddle. So 778 minus 389.49, we're talking about 381.71. This is 381.42 and 381.71 is lower boundary. So there are two things that could happen tomorrow. Well, I mean, there's infinite number of things, but the two things I'll be watching for is if we gap below here, then we could potentially get a positive feedback loop to the downside. And, you know, this is also kind of like a final flag in this situation. And we broke above it and then we're coming down below it, although it did take quite a while. I mean, maybe if we look at it on a weekly time frame, there we go, 1, 2 weeks, 1, 2, 3 weeks back down. So you could justify that that's a final flag. Now, the other thing that could happen, and this is only because this RSI is so oversold, is if it gaps down to like here, like not quite to upper boundary, it could reject and go for gap fill. In fact, I would actually have it, be targeting the average of the last 2-day closes. So 397.48 and 389.49. We'd be looking for 393.50, call it. 393.50. So if we were to gap down here, but not quite there, so let's say we gap down to 382, then I think we're going back up to 393. So it's an $11 move. You could probably make easily a double to a triple on a weekly option with that. But it is Monday. Mondays, the options have more time on them than later in the week. So maybe a double is all that you would target on that. So anyway, this is how we, do our homework to know what those levels are. And then, we should also put that straddle level 778 on top of the number. 397.27. So if we are going to get an upside surprise, it needs to be above 397.27, and then that could lead to a continuation to the upside. So, those are the three cases that we'd be looking for. A gap above this equals go higher. A gap below this would mean go lower. A gap to almost that level but can't get through that level is a bounce back. Those would probably be the three scenarios I'd be looking for. And if any one of those played out, I'd be ready for it based on these options values and the straddle that we calculate. So anyway, it's just the beginning of earnings season, so get ready for a lot of these, and hope you have a good week trading.